Hi everyone, I'm Matt McLennan. I'm a commercial real estate broker with Kidder Mathews in Tacoma, and today's video was actually inspired by a good friend of mine by the name of Kevin Elliot. Kevin is a debt broker for Marcus and Millichap in California, and Kevin made a post about the current debt market, and I'll read it verbatim. Interest rates are rising as the 10-year treasury broke 4%, is nearing levels not seen since 2007. Job data for the month of June surpassed expectations, with the private sector adding 497,000 jobs, exceeding the estimated 220,000. Annual pay rise slowed to 6.4%, suggesting the presence of inflationary pressures. The yield inversion between the 2-year and 10-year treasury stands at approximately 103 basis points. So, what does this mean? Debt and finance markets are driving the real estate market right now. And this is nothing new. We're seeing it in residential, we're seeing it in commercial. It all started last year when interest rate hikes started to high. Now, the common misconception at the moment is that the market's dead. Transactions are not happening. There's nothing we can do. Everything costs more. This doesn't make sense. And simply put, that's not true. We're still seeing a lot of transactions out there. There are a lot of opportunities, but everything is being underwritten differently because debt structures, availability of funds, the ability to finance commercial purchases, and really ultimately what you can pay based on your debt costs is fundamentally different than the cheap money days that we experienced for the several years leading up to those increases in the interest rates. So where I'm going with all this is it's important to underwrite smart. If you're a seller out there, you have to be realistic with your expectations on your sale price. Does not mean you still can't maximize value on your property, but given these changes in the debt markets, I mean, it's just simply put, the numbers have to be looked at and scrutinized in different ways. Cap rates have changed, interest rates have changed, property values have changed, but lease rates and activity and a lot of other factors are still moving in the right direction. So there's ways to bridge the gap. It's just having somebody, multiple people on your team, look at the numbers from a smart standpoint and figure out how to make it work. So anyway, hope that little rant there was helpful. Thank you, Kevin, for the inspiration, and look forward to talking to you all soon.